we'll be looking at IAS 36, impairment of assets. So let's look at some few definitions. So impairment, an asset is impaired when the carrying amount exceeds the recoverable amount. What it means is that if the value, that's the carrying amount, the value in our books is higher than the benefit we expect to get from the asset, either from its use or from its disposal, then the asset has been impaired. I think we've talked about carrying amount when we're looking at IAS 16. I just spoke about recoverable amount. That is the higher of NRV against what value in use. So value in use is the discounted present value of the future cash flow expected to arise from the continuing use of the asset and from the disposal of the asset at the end of its useful life. So once again, because we are making our decisions now, we want to find out how much are we going to get or derive from the asset. If we are to use it, how much is the asset going to help us generate in our normal cost of operation? Okay, take note of this word, how much. So we are looking at future values, but because we want to make our decisions now, then we may have to discount these future values to get their present values. They may tell you that, oh, you get 50,000, but if you do the present value, ordinarily the amount is like 20, or it can be more, depending. Okay, so identify an asset that may be impaired. At each statement of financial position date, review all assets to look for any indication that an asset may be impaired. This is one of the violations we get to see even in practice. Most accountants don't review their assets for the purposes of impairment. Okay. So you have to do that. That's what the standard is saying. At every statement of financial position date, meaning at every year end, you have to conduct an impairment review to see, oh, okay, which of the assets has impaired and which asset has not been impaired, right? And you are doing that, you are comparing, once again, you are comparing the carrying amount against what? The recoverable amount. You can just put this in your head. When the carrying amount is higher than the recoverable amount, the asset has been impaired. Recoverable amount is the higher of NRV and VIU, that is value in use. Or you can say when the carrying amount is higher than the higher of the carrying amount, sorry, the net realizable value and value in use. But that's a little bit confusing. So just use the recoverable amount. Okay, so IAS 36 actually gives us a list of external and internal indicators of impairment. So there is a list, there is some guidance from the standard. You don't get to use your head all the time. Okay. The list kind of gives you what you should look out for, or conditions or happenings in the business environment that will trigger impairment. So for our external sources, we have market values, negative changes in technology, market, economy, or law, increase in market interest rate, and company stocks price below book value. So these are causes of impairment, which is more or less beyond the reach of the company or the control of the organization, right? They are coming from external sources. For internal, we have obsolescence or physical damage. So you can see wear and tear. And one of the reasons why I said this standard or this terminology, people kind of mix it up with the depreciation, okay, is that you see wear and tear here, physical damage. If you ask someone causes of depreciation, the person will tell you that, oh, physical damage, right? But if you look at the standard to a very high level, it attributes depreciation to you spreading the cost over the useful life, right? So you are just recognizing the portion that has been used in the course of the year and not necessarily the assets rusting or a portion being damaged, right? But people get to use the internal sources of impairment as what causes of depreciation. And at the level of financial accounting, level 1 is acceptable. But now we are becoming professional, so we have to get the distinction. Asset is part of a restructuring or held for sale and also worse economic performance than expected. So the asset is not performing as expected. We expect the asset to run for, let's say, 5 years, and the asset, looking at things, is running like 3 years. The asset has been impaired. Okay. So once again, I want to reiterate that this list that I've mentioned, they are not exhaustive. If you even read paragraph 13 of IAS 36, after giving the list, the standard also went ahead to say that they are not exhaustive, right? They may be other factors, okay, that may trigger impairment or cause an asset to impair. So the whole concept of recoverable amount is that we have invested in our assets and we expect to recoup our investment or enjoy our sweat as an investment in the asset. And we can enjoy that benefit in two ways. Either we use the asset to generate money, or we dispose it and make money from its disposal, right? But because we are money inclined, and of course we all want money, we are rational, financially rational. So we will do our analysis and compare the two. How much we will be generating when we use the asset and how much we will generate when we dispose of the asset. Most likely we will choose the one that is going to give us more money, right? So we are saying that the highest between these two is going to be our recoverable amount. Do you get it now? So recoverable amount is the higher of net realizable value and what value in use. So determining recoverable amount. So if the fair value less cost of disposal or value in use is more than the carrying amount, it is not necessary to calculate the other amount. You get it? So what we are saying is that the moment you realize that recoverable amount is higher than carrying amount, there is no need to go and do other computations. We say that the asset is only impaired when the carrying amount is higher than the recoverable amount. When the recoverable amount is higher than the carrying amount, the asset has not been impaired. Okay. So if the fair value less cost to sell cannot be determined, then the recoverable amount is what? Is value in use. Once again, we said recoverable amount is the higher of two figures. So if we cannot find one, we can find the other one. So the other one that we can find automatically becomes what? The recoverable amount. For asset to be disposed of, recoverable amount is what? The fair value less cost of disposal. So if they tell us that, oh, we want to dispose of the asset, okay, then most likely you may have to use the net realizable value. We are not going to use the asset, so value in use will not be needed. You get it? We are going to dispose it off. We are going to sell it. We will recover our investment in the asset through disposal. Okay, so we'll use the net realizable value. Let's look at fair value. Fair value less cost to sell, NRV. So if there is a binding sale agreement, use the price under that agreement less any cost to sell. So if the examiner tells you that, oh, there is an agreement between Portia and Patricia, and in the agreement it is stated that Portia will dispose of the asset to Patricia at an amount, let's say 5,000, that is what you'll be using as what? Your fair value. So if there is an active market for that type of asset, then use what? The market price less cost of what? Cost of disposal, cost to sell. So it's the same thing, cost to sell. Cost to sell. So yeah, so the examiner too will tell you. The reason why I list this is because that is how the examiner, this is like the terminology or the sentence the examiner mostly uses, right, in the exam. So there is an active market for this kind of asset. You get it? Then the examiner will give you the amount. So then you use that as what? Your NRV. Market price means current bid price if available. Otherwise, the price in the most recent transaction. So if the examiner tells you that, the examiner doesn't give you any agreement, or the examiner doesn't tell you there is an active market, but the examiner can make reference to a past transaction. Okay, then you assume all things being equal, it should be the same. Okay, then you use that. If there are no active market, use the best estimate of their asset, the asset selling price. I think I said this last week, last 2 weeks, that the standard permits us as accountants to make estimates. Of course, we are not prophets. I keep saying this. We are not prophets. We are only accountants. If we are prophets, we can pray and we say, God have shown me the figure, right? But we are accountants, so we can only estimate. And when it comes to the estimation, we consider other things, right? Just like depreciation, we consider the usage, then we estimate the useful life. Cost of disposal are what? Are the direct added cost only, right? So we are looking at cost that we are incurring, which is directly attributable or linked to the disposal of the asset. Most likely, the examiner will give you a scenario where you have to pay an agent, a commission to an agent to dispose of the asset, and that will be a cost you have to incur to dispose of the asset. So value in use. So the calculation of value in use should reflect the following element. So 1, an estimate of future cash flows the entity expects to derive from what? From the asset. So once again, estimate of what? Future cash flows. Expectations about possible variation in the amount or timing of those cash flows. So then the time value of money, represented by the current market risk-free rate of interest. So the examiner is supposed to give you the risk-free rate of interest, or the rate that you should use or you would use for what? For discounting your future cash flows. Then the price for bearing the uncertainty inherent in the asset. We have other factors such as illiquidity. The market participant would reflect in pricing the future cash flows and the entity expects to derive from the asset. Estimate of future cash flow should not include cash inflows and outflows from financing activities or income tax receipt and what? Payment. We will talk about that. Then in measuring value in use, the discount rate used should be pre-tax rate that reflects the what? Current market assessment and time value of money and the risks specific to the asset. And those doing FM will know pre-tax and post-tax. Post-tax. When you are doing your investment appraisal. Okay. But this is financial reporting, so we will not go into details. The examiner will not even give you rates that will confuse you, because the main thing is not even on the value you use. You just want to use the value you use to determine whether the asset has been impaired. So the examiner will not give you a question that you will go deep into those finance stuff. The examiner will give you the rate, and the examiner will tell you that the rate that has been given is pre-tax. If the examiner doesn't tell you, just go ahead and assume that it is pre-tax. Okay. So recognition of an impairment loss. An impairment loss should be recognized when recoverable amount is what? Is below the carrying amount. The impairment loss is an expense in the income statement unless it relates to what? A revalued asset, where the value changes are recognized directly in what? In equity. Also, we have to adjust what? Depreciation for future use. There will be a need to adjust your depreciation now that we have to write down the asset from its carrying amount to its recoverable amount, meaning the carrying amount, assuming we had 5,000, okay, in our carrying amount, as our carrying amount in our books, and let me use recoverable amount rather than NRV. It's 4,000. Okay, it means our asset has been impaired by what? 1,000. So we will write the asset off from 5,000 to 4,000. Okay, so definitely it's going to affect our depreciation charge going forward. Determining impairment loss. So 5 steps. Step 1, determine the carrying amount. I just did these simple steps for you. 1, you determine the carrying amount. 2, determine the value in use. Most likely, maybe Jumanebe will be in the value in use, because value in use, they will give you the cash flow for, I think, 5 years. Some of them are 5 years. Some of them, to the examiner, will just give you straightforward. If it's 5 years, you have to discount each of them. Then you determine the NRV. Then 4, you determine the recoverable amount. So the recoverable amount, you just compare this and this, then you pick the highest, right? Then after you have determined your recoverable amount, you can now compare your recoverable amount to your carrying amount. And if your carrying amount exceeds your recoverable amount, then the asset has been impaired. If not, the asset has not been impaired. Okay, let's look at this question. The following information relates to 3 intangible assets. So we have the net book value, we have the net realizable value, and we have the value in use. So for patent, our carrying amount is, so net book value, the same as what our carrying amount. Carrying amount. Okay, so our carrying amount is 550. Now our recoverable amount is what? The higher of our net realizable value and value in use. So we are going to pick this. So we now compare 750 to 550. If our recoverable amount is higher than our carrying amount, then the asset has not been impaired. So it means patent has not been impaired. So let me write not. Goodwill. Let me call someone.
All right. So the recoverable amount is the higher of the net realizable value and the value in use. So in this place, it's 650 cedis.
650. Okay.
And then the carrying amount over here is the 900,000. So
Okay.
since the carrying amount is greater than then the asset has been paid by the difference between the recoverable amount and the carrying amount.
Okay. All right. Thank you. So and that's 250, I guess.
Yes, sir.
Okay.
So with copyright, the recoverable amount here will be 650,000.
600.
Yes,
Okay.
that is the highest between the net realizable value and then the value in use.
Okay.
And then our carrying amount is 800,000. So the difference is going to be 150,000.
150,000. Okay.
Yeah.
Okay. So yeah, the asset has been impaired. So yeah.
Yeah, so the asset has been impaired.
Okay. Thank you. Thank you. Thank you.
Sir.
So yeah, that's our solution. Okay, so let's look at reversal of impairment. We said anytime the carrying amount of an asset is higher than the recoverable amount, then the asset has been impaired, and the difference, which is impairment, is treated as an expense in our profit or loss statement. So what happens if we want to reverse the impairment that has been recognized? So in order to calculate impairment loss, future economic benefits accruing from the use of the asset are predicted. And in some cases, the actual outcome turns out to be better than projection. So yeah, the value in use that we just computed, it is not constant that year 5 or year 4, I think year 5 was around 500,000 or 800,000. It's not constant that we will get to that amount. Sometimes you can make good gains than anticipated. Okay. So if this happens, then any impairment loss which has already been recognized will need to be reversed. So same approach as for the identification of impairment assets. Assess at each statement of financial position date whether there is an indication that an impairment loss may have decreased. If so, calculate what the recoverable amount. No reversal for unwinding of what discount. The increased carrying amount due to reversal should not be more than what the depreciated historical cost would have been if the impairment had not been recognized. Reversal of an impairment loss is recognized as what? As an income. It's recognized as an income in the income statement or the profit or loss statement. That was what I wanted to say. However, if the original impairment loss was charged against revaluation surplus, the reversal amount should be treated as what? other comprehensive income and credited to what? Revaluation surplus. I am hoping that by God's grace, we've not forgotten how we treated revaluation gains. We said revaluation gains goes to what? Other comprehensive income, and we accumulate it to where? In revaluation surplus in our changes in equity. So we are saying that ordinarily we are going to treat impairment loss as an expense in our P&L. We can also charge it if we have any revaluation gains. We can, instead of passing it as an expense, we can go and use to reduce our revaluation gains. Okay, so in the case of a reversal, because ordinarily we would have treated it as an expense, the reversal would have been what? An income. In the case where it was passed against revaluation surplus, which reduced the revaluation surplus balance, and we are now reversing it, we will pass it in what? Other comprehensive income, and we will go and add it back from where we subtracted or we deducted the initial loss that was recognized. So adjust depreciation for future periods to reflect the changed carrying amount, and also reversal of an impairment loss for goodwill is prohibited. So this IAS 38, intangible. They have special needs, so I'll talk about it later. Okay, so impairment loss and revaluation is this. I think we've talked about it, but let's look at it. So where an asset is carried at revaluation and there is a standing revaluation reserve, any impairment loss on the same asset will have to be treated as what? A revaluation decrease. Any excess of impairment over revaluation loss should be treated as an expense in the statement of what? Profit or loss. So where we have revaluation gains, we said revaluation gains, other comprehensive income, and we'll be accumulating it in what? Revaluation surplus in our changes in equity. So where we are having an impairment loss on that same asset, then the revaluation gains that we are accumulating in our changes in equity will be reduced by what? The impairment loss. And in a case where the impairment loss is so huge that it takes away all the revaluation and there are still losses, then the difference, those losses should be recognized as an expense in our P&L. Example, the revaluation surplus that we have in our changes in equities, let's say 5,000, okay? And when we did our impairment testing, we had an impairment of 7,000. So what we are going to do is we are going to write down this 5,000 in our changes in equity to 0, okay? So 5,000 out of this 7,000 will go here. Then the remaining 2,000 will go in our P&L. So P&L 2,000 as an expense. We first have to write down the revaluation surplus to 0. Then we take the difference, the remaining, to our P&L as an expense. Any question? Any question? Okay.